Silver isn't rallying, it's rationing, and the market is trying to pretend it's still business as usual. The conflict is simple. The headline crowd keeps calling this a speculative burst that can be talked down, while the plumbing of the silver market is flashing the kind of stress that forces price higher, whether anyone likes it or not. And the hidden mechanism most people are missing isn't a rumor or narrative or viral chart. It's the spread. It's the curve. It's what's deliverable versus what merely exists somewhere on a spreadsheet. Stay with me, because by the end you'll have a clean next 2 weeks checklist, the levels that matter, and the one thing that breaks first if this move is about to turn into a real squeeze. Look at how silver has behaved right now, today, this week. You don't get a clean staircase. You get a surge toward the low to mid-90s, and then a violent snapback that takes a chunk out of price in a single session. That's not a gotcha against the bullish case. That's what stress looks like when liquidity thins, and leverage has to be reset in public. Silver can go from unstoppable to what just happened? In hours, and that's the point. It's the market shaking out weak hands, pressuring margin, and forcing participants to choose. Pay up for collateral or reduce risk. And that's where the real pressure starts. Because when you see an intraday pullback that sharp right after a fresh high, the knee-jerk explanation is always profit-taking, or overbought, or speculators got too excited. Fine, sure, sometimes that's true. But the higher probability explanation in this environment is mechanical. Silver has become more expensive to hold, more expensive to trade, and more expensive to short at exactly the same time that physical demand and industrial pull have not politely stepped aside. When the exchange raises margin requirements in a volatile market, it's not moralizing, it's math. It says, if you want to play, you need more collateral. And that single demand can turn a trending market into a whipsaw machine. But that's not the part that matters. What matters is what those margin dynamics force participants to do. If you're long with leverage, higher margins can force you to cut size, even if you still believe the thesis. If you're short, higher margins punish you twice. First, by requiring more collateral as price rises, and second, by raising the cost of surviving the move long enough for you to be right. And when margins shift toward a percentage-based framework, the squeeze potential becomes more automatic. The higher price goes, the more collateral it demands, and the more the weakest balance sheets are forced to reduce exposure. That's not a prediction. That's a mechanism. And in metals, mechanisms move price faster than opinions. Now layer that on top of something most retail traders underestimate. The silver market is not just a chart. It's a supply chain, it's a delivery system, it's a set of contracts and warehouse categories and settlement norms. And silver has a unique problem that makes supply stress show up suddenly. A huge amount of silver supply is mined as a byproduct of other metals, lead, zinc, copper, so silver doesn't ramp like a pure silver mine would. If silver doubles, it doesn't magically double output next quarter. Those projects have lead times. The primary driver for that mine plan is often a different metal entirely, so supply is slow. Demand, on the other hand, can accelerate in weeks, and that mismatch is where prices rise faster than anyone expected. You've probably heard industrial demand is strong 1,000 times, and it can sound like background noise. But industrial demand in silver is not a side character anymore. It's a main character with a schedule and a procurement mandate. Solar is not a vibe, it's a build-out. Grid upgrades are not a slogan, they're a capex pipeline. Electronics and high-end computing aren't optional, they're strategic. And silver is used precisely because it's silver, because conductivity is not something you can replace with a motivational speech. Yes, there is thrift and substitution over time. Yes, engineers fight for pennies per unit. But the near-term reality is that demand can be sticky, even when price spikes, because production lines don't stop politely. They secure supply first and debate later. And if you want to understand why silver can gap higher, start there. Here's where the proof stack begins, because you don't want one argument. You want layers. Layer 1 is the structural backdrop. The market has been dealing with multi-year deficits, periods where demand exceeds supply, meaning the gap is covered by drawing down above-ground stocks, recycling flows, and inventories that were built in calmer years. Even if the annual deficit narrows, the cumulative draw matters. Think of it like a household running a recurring shortfall. You can cover it for a while by dipping into savings, but the day you realize the savings account isn't infinite is the day behavior changes. The day behavior changes is the day price reprices. And that's where the real pressure starts. Layer 2 is the byproduct constraint I mentioned. Silver is a passenger on other mining economics. That means even if silver is screaming higher, a mine operator focused on lead or zinc might not change their plan immediately, especially if their bottleneck is permitting refining capacity or financing. Layer 3 is refining and logistics. In metals, supply exists is not the same as supply arrives. The metal needs to be in the right form, meet the right specs, be in the right location, clear the right channels, and show up when the contract needs it. Any friction in that chain can create a short-term squeeze even if global tonnage looks fine on paper. And that brings us to the hidden detail, deliverable supply versus total supply. This is the part most people skip because it sounds boring. It's not boring, it's the entire game. In futures-driven metals, what can actually be delivered against a contract, on time, in spec, in the right place, matters more than aggregate production numbers. There are inventory categories that look comforting until you ask the only question that matters. How much of that inventory is available to settle pressure right now? Because eligible is not registered, stored is not free, and in a vault is not the same as ready to move. This is where squeezes are born. So when you hear someone say, "There's plenty of silver in vaults," don't argue. Just translate. Ask, plenty of silver in what form? Owned by whom? Encumbered how? Available on what timeline? Because vault totals can rise and the market can still be tight. Vault data is a transparency tool, not a stress test. A vault can be full of metal that is already spoken for, already allocated, already tied to financing deals, industrial contracts, or long-term storage. It's like looking at a parking lot and concluding there are lots of cars for sale. Those cars are owned. The lot being full doesn't mean the dealer has inventory. That distinction is what flips the whole setup. Now let's talk about the curve and the spread, because this is where paper meets physical. In a calm market with plenty of immediate supply, future prices can trade above spot because there's cost to carry, financing, storage, insurance, and the market is basically saying, if you want it later, fine, it costs a bit more. Well, that's contango. But when the market gets tight in the front, you start seeing the opposite pressure. The front month gets bid, nearby spreads firm, and the curve can flatten or invert. That is the market screaming that now is more valuable than later. And it's not because traders got emotional, it's because the immediate stuff is harder to secure. The spread is telling the truth even when the spot price tries to look calm. And this is where institutions pay attention. Funds can trade spot, industrial users can't, mints can't, refiners can't. Procurement teams care about delivery windows, not vibes. If the curve is tight, it punishes anyone who tries to wait for a better price, because waiting can become more expensive than paying up. That's how you get rationing behavior. And that awing is why silver can rise faster than anyone expected, because the market structure forces urgency. Here's another layer, volatility. High volatility doesn't just scare people, it changes the rules. When volatility jumps, margin requirements jump, bid-ask spreads widen, and liquidity providers step back. In plain English, it gets harder to trade size without moving the market. That creates air pockets, and air pockets are where silver does its most dramatic work. One wave of buying can push price through levels that normally would take weeks. Then because the move is so fast, risk systems trigger, funds rebalance, traders de-risk, margins get hit again, you get a pullback. People call it a top. Then the market reloads, then it punches again. That's the rhythm of a stressed bull market in metals. But that's not the part that matters. What matters is that in this environment, volatility is not just noise. It's the weapon the market uses to shake you out of correct positioning. Silver is famous for it. It can whip around violently even if the larger thesis is right. It can do a brutal red candle right before the next leg higher. It can overshoot, retrace, and still be in a structural uptrend. And if you don't separate trend signal from noise, you become exit liquidity for the people who can survive the collateral demands. So let's zoom back out and ask, why now? Why not 6 months ago? Why not later? The why now is the calendar plus the plumbing. In precious metals, delivery cycles matter. Option expiries matter. Fund rebalancing windows matter. When you combine a hot market with delivery windows and heightened margin regimes, you get forced behavior on a schedule. Traders can't just say, I'll deal with this later, because later might mean first notice or roll deadlines or risk committee limits or margin calls. And when the market is near psychological levels, like the 90 area or the 100 magnet, behavior becomes even more constrained because risk managers and liquidity providers know those levels attract the most emotional trading. That's where the squeeze potential increases, because the crowd shows up at the same time the market becomes least able to absorb them. There's also an accessibility catalyst hiding in plain sight. When exchanges introduce smaller contract sizes, participation changes. It doesn't mean price must go up, it means the microstructure changes. New contract formats can increase engagement, especially from smaller participants who previously couldn't or wouldn't touch a full-size contract. More participation can mean more liquidity in normal times. In stressed times, it can mean more chasing. And if that coincides with a market already sensitive to margin and spreads, it can add fuel at exactly the wrong moment. Wrong for shorts, wrong for anyone assuming the market will behave normally. Because if this one level breaks, the math changes. Now, let's address the skepticism head on, because the audience you're speaking to doesn't want cheerleading. They want logic. The counterpoint is real. Silver can spike on speculative flows, then mean revert hard. Silver can run hot on macro fear, then cool off if the macro tape improves. Silver can see substitution and thrift if prices stay elevated long enough. Recycling can respond over time. Jewelry and some investment demand can be price sensitive. And if the curve relaxes, if spreads ease, if availability improves, you can absolutely get a controlled pullback that feels like the story is over. But here's the rebuttal. Those counterpoints are mostly medium-term adjustments. The next week or two is driven by what has to happen, not what might happen in an idealized equilibrium. Procurement doesn't stop because Twitter turns bearish. Delivery windows don't move because a strategist says overbought. And leveraged positions don't politely unwind. They get forced. That's why the near-term roadmap matters more than the long-term opinion. The market is living in the short-term constraints right now. So what do you watch next, this week and next, if you want to trade this like a strategist instead of a headline tourist? First, watch the behavior around key levels on closing basis, not intraday drama. In a market like this, intraday spikes and flushes are designed to confuse you. The more important signal is whether silver can reclaim and hold the big round numbers after the volatility event. The $90 zone matters because it's both psychological and structural. When silver pushes above it, it pulls in trend followers, triggers systematic flows, and forces shorts to reassess. When it loses it, it invites top narratives and accelerates stopouts. A market that is truly strong tends to defend those levels on closes, even if it violates them intraday. Second, watch the nature of pullbacks. A controlled pullback is one where declines are choppy, volume is not panicky, and the market quickly finds buyers near prior breakout levels. A dangerous pullback is one where the bounce attempts are weak, rallies get sold immediately, and the market starts closing below successive supports. In this environment, the high 80s are a key battleground. If you see repeated failures to regain that zone, that's your first warning that leverage is unwinding more aggressively than demand is absorbing. But if you see violent dips that get bought quickly and price snaps back toward that region, that's often the reset behavior that precedes another push. And that's where the real pressure starts. Third, watch the curve and spread behavior. You don't need to be a professional spread trader to understand the message. If near-term pricing stays firm relative to later months, it's telling you the market is paying for immediacy. If the curve relaxes and the front stops being special, that's telling you immediate stress is easing. The spread is the lie detector. It tells you whether the market is pricing scarcity now or just pricing a story. Fourth, watch collateral conditions. When margin requirements rise, the first wave is forced selling and trimming. That can create the dramatic pullback everyone points to as proof it was a bubble. Then comes the second wave, which is more subtle. Weaker hands are gone, and the remaining participants have stronger balance sheets. If demand persists, price can restart with less overhead supply from panicked longs. In other words, the same mechanism that creates the drop can set up the next advance. That's not always what happens, but it's common enough in metals that ignoring it is a mistake. Now let's map the two scenarios because this is where credibility lives. Scenario 1 is the controlled pullback and retest. In this scenario, silver cools off after the spike, chops around, and retests the breakout region. Think high 80s down toward mid 80s, potentially even probing lower if risk-off hits. The key feature is that the market does not collapse, it consolidates. The curve doesn't completely unwind. Physical tightness signals don't vanish overnight. And after a few sessions of frustration, silver starts printing higher lows again. In that scenario, the $90 area becomes the ceiling it has to reclaim, and once it does, the market aims back toward the recent highs. It's a slower path. It's a healthier path. And it's the path that tempts people to get bored right before the next move. Scenario 2 is the continuation squeeze. In this scenario, the pullback is shallow or short-lived, and silver reclaims the key level quickly. Liquidity thins, spreads stay tight, and the market starts to behave like it's in a hurry again. This is where gaps become a risk. This is where stops don't fill where you want. And this is where $100 stops being a target and becomes a magnet. Because once you get close enough, the market starts to trade the psychological boundary itself. Traders front run it, shorts reduce, momentum funds add. And the price action can get irrational, not because the fundamentals changed overnight, but because positioning and liquidity changed. That's the scenario where silver rises faster than anyone expected, and everyone has a different story after the fact. But the mechanism was always there. So what would confirm each scenario? For scenario 1, confirmation is a sideways to down chop that holds structure. Buyers stepping in on dips, closing resilience near the prior breakout zone, and the market refusing to let selling turn into a cascade. For scenario 2, confirmation is quick reclaim of the key round level, renewed strength into the close, and continued firmness in the now versus later signal. What would weaken the thesis? A meaningful relaxation in the curve, Easing of tightness indicators and repeated failures to reclaim key levels on closes. What would invalidate the near-term squeeze narrative? If silver loses the mid-80s area and stays below it with heavy sustained selling pressure, while the spread structure cools and the market starts behaving like supply is comfortably available again, that's not a permanent bearish verdict. It's simply the market telling you the immediate stress narrative is wrong. And that's the difference between risk framing and hype. Now let's talk about the psychological trap, because this is where most people lose even when they're right. Volatility is not just a chart feature. It's an emotional attack. Silver will try to make you chase the green candle and puke the red candle. It will try to make you anchor to an intraday high and feel late and stupid if it pulls back. It will try to make you interpret every dip as betrayal and every spike as salvation. And if you fall for that, you end up trading your feelings, not your thesis. The antidote is simple, but not easy. Decide what you're actually trading. Are you trading a short-term move driven by spreads and calendar pressure? Or are you trading a structural supply and demand regime shift? Those are different time horizons. Then define what counts as signal and what counts as noise. In a market like silver, a one-day flush is often noise if the structure holds. A repeated failure to reclaim key levels on closes is more signal. And above all, respect that a correct thesis can still deliver a painful path. Price can whip around violently even if the setup is right. If you size so big that normal silver volatility becomes intolerable, the market doesn't need to beat you with fundamentals. It just needs to shake you. And silver loves to shake you. Here's a practical way to think about it without giving anyone a false sense of certainty. Treat the market like a storm system. The trend is the pressure gradient. The daily candles are gusts. Gusts can knock you over, but they don't necessarily change the direction of the storm. If you only watch gusts, you'll believe 10 different stories in 10 days. If you watch the pressure gradient, spreads, curve behavior, closing levels, and calendar constraints, you're less likely to get emotionally hijacked. And that's where the real pressure starts, not on price, but on your decision making. Now, let's revisit the core claim. Why prices are rising faster than anyone expected. It's because silver is one of the few markets where industrial demand, investment psychology, and futures microstructure can stack on top of each other at the same time. When the market is calm, those forces take turns. When the market is stressed, they synchronize. Industrial users secure supply. Investors chase momentum and hard asset narratives. Spreads signal immediacy. Margins force deleveraging and short covering. Liquidity thins, price jumps. That's the stack. And you only need one or two of those forces in a normal environment to get a move. Right now you have multiple. There's also an institutional behavior angle that's quiet until it isn't. When markets start printing new highs and volatility rises, institutions don't all rush in. Some step back, some hedge, some rebalance, some increase collateral. But the key is that risk management becomes the driver. And risk management is mechanical. It doesn't care about your narrative, it cares about limits, it cares about VAR, it cares about margin. That's why you can see a sharp retreat even as the longer-term path points higher. The market is forcing participants to survive the journey, not just predict the destination. So where does that leave you right now, today, this week? It leaves you with a roadmap, not a prophecy. The market has shown it can trade above the $90 region and flirt with the mid-90s. And it has also shown it can punish complacency with a fast drop into the high 80s. That's the battlefield. If price regains the key zone and holds it on closes, the upside magnet is obvious, the prior high and then the psychological $100 boundary. If it can't, and it churns below, then the market may be choosing scenario 1, a reset and retest before the next decision. Either way, the thing to avoid is the emotional middle, chasing the top of a spike and panicking out on the flush. Because that's exactly what this market is engineered to induce. And here is the subtle point most people don't want to hear. You don't have to do something every time silver moves. The edge comes from knowing what to watch next and letting the market tell you which scenario it yes choosing. Watch the closes. Watch the curve behavior. Watch collateral dynamics. Watch whether the market is paying up for immediacy. Those are the tells. The rest is noise designed to steal your focus. One more thing before we close, because this is where trust is built. If you hear anyone tell you silver must do anything, be skeptical. Markets don't owe you follow-through. What they do offer is a set of constraints and incentives. Right now, those incentives are aligned towards stress. Constrained near-term supply responsiveness, sticky industrial demand, heightened volatility, and a margin regime that forces action. That combination can absolutely push silver higher faster than consensus expects. It can also produce violent pullbacks that scare people out before the next leg. Both can be true. And the trader who survives is the one who plans for both. So here's your next week checklist in plain language. 1. Can silver reclaim the big round number zone and hold it on closes, or does it keep getting rejected? 2. Do pullbacks get bought quickly, or do they bleed and fail to bounce? 3. Does the now versus later signal stay tight, implying urgency, or does it relax, implying stress is easing? 4. Do margin and volatility conditions remain elevated, forcing position management, or do they cool enough that liquidity returns? If you track those 4, you'll be ahead of 90% of the commentary. And if you want a quiet, identity-based CTA that doesn't feel like begging, here it is. Stay on the side of mechanics over hype. If you're the kind of investor who wants the why behind the move, not just a price target shouted into the void, you're in the right place. Drop your key level in the comments, the one you think decides whether this is a retest or a squeeze, so we can compare notes as the market prints the answer. Because the next detail is what flips the whole setup.